You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, last week we did a huddle up with myself and Mark Longo. I always love to be able to get together and answer some listener questions. So this week we're just going to look at a new strategy, and we have the megalodon of earnings coming this Thursday. And I should mention that we are taping Options Playbook Radio. It is Wednesday, February 1st, and the markets are closed right now. And tomorrow after the close would be Thursday, February 2nd. We have Apple, we have Google, we have Amazon are the main stocks that are announcing tomorrow, and they're all announcing after the close. So they all kind of play off of each other a little bit, but definitely the biggest day of this quarterly earnings announcement period. So with that said, you could do this strategy on any of those stocks that are mentioned. I'm going to do Apple. Apple is the most widely held underlying at Ally Invest. And I'm going to look at a bearish trade. I haven't had this opportunity to do this that often. I'm not necessarily bearish or bullish on the FANG stocks. And as always, whenever we're looking at strategies here on Options Playbook Radio, they're not meant to be recommendations. But we have had a fairly decent run up in the NASDAQ recently. Since the beginning of the year, we've seen some strength and there are some headwinds. So even though we have potential to hear some decent earnings, everybody's going to be weighing on, what are potential layoffs, what's coming. It's going to be all about the forecast after the earnings announcement. So with all that said, it's an opportunity to, once you've had a decent run up in a stock like Apple, to maybe sell some of it off. So I don't want to take a lot of risk on this trade because, as I mentioned, big tech has done well recently. So we're going to approach it very cautiously, and we're going to look at what's called a Christmas tree butterfly. And let's talk about the strategy. There are over 40 strategies in the Options Playbook. I don't get to address all of them, but I always try to look at situations where a new strategy or newish, we've been doing so many episodes of Options Playbook Radio. I'm sure I've talked about a Christmas tree butterfly before, but it's going to be a limited risk. It will have a net debit that we're going to pay through the account, and that net debit is going to be our maximum risk on the trade, just like a standard butterfly. But we're going to skew the butterfly. We'll be buying one of the 140 strike puts, and we're going to be selling 3 of the 136 strike puts and using some of those proceeds to hedge ourselves and buy 2 of the 134 strike puts. Now, the key to make this a Christmas tree butterfly, and basically it's a leaning butterfly would be a better name, but I don't know why it got the name Christmas tree. But with that said, if you look at that trade, the important way to know that you are covered is that the legs that you are buying add up to the legs that you are selling. So the number of legs that we're selling are 3. We're going to buy 1 of the expensive puts and then go out and buy 2 of the inexpensive puts. 1 plus 2 equals 3. So we're going to be covered on this trade, which also means you're not going to get it done for a net credit to the account like a skip strike butterfly or some other ratio that we'd be looking to do. In this situation, we're also not going to have even strike prices. We're going to give ourselves a little bit wider swath on the positive side of things for the stock to land in. But it also means that if it goes against us hard, that it's going to hurt us quicker too. So here's the scenario. We have Apple trading right now on the close on Wednesday, February 1st at $145.43, $145.43. The stock was up $1.14 on the day. So I have mentioned about the dynamics of option pricing and the fact that Amazon always seems to announce on a Thursday before a Friday expiration. And in this instance, we have Apple and Google. They don't always announce on a Thursday. They announce different days of the weeks. Amazon is the one that always chooses to announce on a Thursday. So in this instance, when we have Apple announcing on a Thursday, that means that we can pick the February 3rd expiration, and that these option contracts will only have 1 full day of life after the earnings announcement, 1 trading day. So in a butterfly scenario, I don't care if it's a Christmas tree or even a skip strike, if you're correct on your forecast and you want that underlying to stop at your short strike, you want as much time premium to erode on that short strike as possible. Your ideal situation would be that there is no time premium on the short strike option contract as close, and you are at the expiration date with the stock as close to the strike as possible. So you set up that scenario where you have some pumped up volatility, some pumped up option contracts, which will make the butterflies cheaper. But you also know that if you are correct on your forecast, every hour that goes by of that trading day, you're going to look better and better on your option trade. Now, because of the pumped up volatility, we're going to be able to do this Christmas tree butterfly for a very reasonable rate. And if we are dead wrong, we're going to lose that. But it's going to be a fairly insignificant amount relative to buying a put or a call option outright. So as I mentioned, we're going to be a little bit bearish on Apple this time around. You could take the same concepts and apply it if you want to be bullish. We looked at the 1 standard deviation move. Now, not one, the expected move is a better term to use. And that's right around 6 points. So if you look at the money 145 strike call and the 145 strike put, you'll see that that's trading for just shy of $6. So if you take 6 minus 145, you're looking at about 139. So we want to be within that range. So the strike that we're going to buy is the 140 strike put with that February 3rd expiration. This is the one this is the strike or the option contract that we're hoping is going to do the lion's share of the work here. We don't want it to gap open more than the expected move. Ideally, it would open right around that expected move price and then drift lower towards our short strike. And our short strike here is going to be 4 points away. It's going to be the 136 strike put. Now, here's the little tweak to make it a Christmas tree. We're going to be selling 3 of those. So we're bringing in a lot of premium. And then we're going to go down to offset the fact that we bought 1 and sold 3. we need to hedge ourselves a little bit more. So we're now going to buy two, go 2 more points out of the money, half the distance of the initial spread, and buy 2 of the 134 strike puts. Now, they are the cheapest option here. It's the furthest out of the money option contract. So to say it quickly, stock's at 145.43. We're going to buy the February 3rd 140 strike put, sell 3 of that February 3rd 136 strike put, and then buy 2 of the February 3rd 134 strike put. We're going to get this done for a net debit of 34 cents to the account. There's no more additional margin. We are covered. I have a long 4-point wide spread, but we are short 2 of the 2-point wide spreads. That means that the maximum we could make on the long spread is 4 points. The maximum we could lose on the 2 short spreads is 2 + 2 or 4 points there. So there's no more additional risk. 34 cents is the net debit to the account. Now, I find this interesting and worth noting that we're able to do this, and that means that we're just a little bit more than the expected move is what we're looking for. Hoping that it's going to be to the downside. That's the biggest question mark, right? Flip a coin. Are we going up? Are we going down? Is the news going to be considered good or bad? If it does go down, we want it to go down about the expected move, which is 6 points. I would put it right around 139. And then drifts slower down towards that 136 level. So if that is the case, the maximum the spread could trade for is $4. The width between the long put spread from 140 down to 136. If it lands right on 136 in a utopian scenario, that means the 136 and the 134 strike puts would just expire worthless. You'd be long the 140 put contract, and that should be trading for about $4. And hence that would be the maximum that you could make on this trade. So it's a very interesting trade to look at, not a lot of risk on the upside. And the point that I was going to make is that the 136 strike put is actually trading for what the skip strike butterfly is being traded for. So the midpoint of the skip strike butterfly right now, never guaranteed a midpoint fill, is 34 cents. So you pay $34 plus commission to put on this trade. If you just bought the 136 strike put outright, the bid is 34 cents and the ask is 37 cents. So if we just say that you could get it on the bid, which would be a really good fill, you'd pay 34 cents for it. So here's what the difference is. You're like, well, why wouldn't I just buy the 136 strike put? Because if the market did go down 6, that 136 strike put would be basically worthless, right? If it made that expected move on the 136 strike put, all of the vol premium would get sucked out of the put options. You have 1 day for that to live. And if it didn't continue on down from 139 after it made a 6-point move to the downside and started to drift lower, if it didn't go below 136, it would be very hard for you to even break even on the trade. So in this scenario, we put up about the same amount of capital, and we have the benefit that we start getting good on this trade below 140. So this would be your homework if you're doing this trade. And what would most of the beginning option traders do? They would just buy the 136 strike put. I have $34 that I want to invest or speculate on Apple's earnings. What put option can I buy? I'm going to buy the 136 strike put and hope that I make money on this trade because Apple's going down. Well, this is a very interesting alternative to it. We keep our risk at the same amount, but we start benefiting much, much sooner on Apple's movement. If it is to the downside, you still got to get that right. If it is to the downside, then we would if we just bought the 136 strike put outright. So if you're doing a paper trade, I would make note of both of them. I'd make note of where the where the skip strike butterfly is at, and also where the 136 strike put is at. And then you want to look at the open. Market open is 9:30 a.m. tomorrow. See where the puts are and calls or puts are trading at. And a lot of times, if I'm doing a trade like this, I'm probably out before noon. Might even get out if it trades anywhere near 136 in the first couple hours of trading. I'm just going to get out of the trade. I'm not even going to necessarily look at what the profit is because I don't want it to break hard to the 134 level. I should be up on the trade, but I obviously will do a lot better if it closes closer to 136 at the actual expiration, which is Friday at 4 p.m. Eastern time. So that would be my best case scenario. All right. So one last review. Apple trading at 145.43. We're doing a skip strike butterfly. We're going to use the expiration this Friday, February 3rd. We are going to buy the 140 strike put, sell 3 of the 136 strike puts, and then go out and buy 2 of the 134 strike puts. Right now, we can get that done for a net debit at the midpoint of 34 cents. Total risk would be $34 plus commission to put the trade on. And as always, normally I would wait till a little bit closer to the close before I would look at this trade. That's just, we tape Options Playbook Radio usually on the close on Wednesday. And I would probably wait around and see, exactly where these prices are at a little closer to the close. But with that said, we'll come back and we'll look at this one. We'll see how it prices out. I will take a screenshot of it. I will look at the 136 strike put and how that reacts relative to the skip strike butterfly. Thanks for coming, everyone. And if you'd like to learn more about what we're doing here over at Ally Invest, please follow me on Twitter. My handle is @BrianOverby. You can email me directly at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.